Hello, everyone. Thank you so much for joining us again on our weekly mortgage real estate update. Today is June the 11th, and I have the pleasure of being joined yet again by Kayla Frerot, home financing advisor of ScotiaBank. If you don't know who I am, my name is Alex Ward, and I'm the broker owner of Maxwell Devonshire Realty and the 2022 award recipient for the Broker of the Year for the Real Estate Association of Alberta. If you're listening to this live, hello. If you're watching this either on our YouTube or podcast, please hit that subscribe button, and we would love for you to get our weekly content. Kayla, rates got increased. Bank of Canada announced a 25 basis point rate increase. What does that mean for our home buyers and home sellers?
Yes, so they met last week on Wednesday, and they did increase the rate by 0.25. So right now, the major banks, our prime rates have gone up to 6.95 from 6.7. So not the 0.5 hike that Alex thought there was, throwing it out there. So the 0.25 hike, what does that mean for you? So it's really going to come down to, do you have any variable rate products? So is your mortgage a variable rate mortgage? If it is, that means obviously the interest rate has increased, and there's going to be more going towards interest rather than your principal. If you do have any of the variable rate credit products as well. So if you have a line of credit, any credit cards that are based on that rate, that is going to be, you're going to see an increase as well in those payments if you're carrying a balance. Now, we do think that it's not the last hike that they're going to have before the end of the year. Bank of Canada is going to meet again on July 12th to talk about those interest rates again. And we'll see what happens. But we do think there is going to be one more hike before the end of the year. That's kind of what the projection is there. And again, as we kind of stated last week, it has to do with inflation, lowering that inflation rate. And it's not the best thing for us here as homeowners if you are with the variable rate side of things. And if you are having trouble with those payments, or that increase is becoming a lot for you, I do suggest talking to your banks, seeing what kind of options are there as far as looking at those increased costs and how that affects your total financial picture. Even though they have increased the rate, we are still seeing people buying. The market is fairly busy, even though it doesn't seem that way, because there's inventory is at an all-time low and demand is high. So we are seeing houses selling quite quickly once they're on the market. We're still at 2018, 2019 levels as far as buying power there. So things are still moving, which is good. And that's kind of the update that we have so far.
With that's great that people are still buying and selling. How much, and affordability you were saying is close to that 18, 19 mark. How much should this rate increase actually impact someone's ability to buy?
Yeah, so there's a couple different pieces that go into that. So if we're looking at a single income and they have no debt, and the interest has increased by the 25 bips there, then we're looking at about 40 to 50,000 in pre-approval amount, depending on what rate they're getting, right? Because when we qualify, we either qualify at 5.25, which is the Bank of Canada qualifying rate, or the contract rate +2, which is more normal at this point, unless you're porting your mortgage. So whatever contract rate you're getting, let's say you're getting 5.5, then we're increasing that by 2%. So if you're looking at the variable rate mortgage, that's where it's going to qualify. It's going to change your qualifying rate and your buying power. If you're looking at the fixed rate mortgages, us at Scotiabank, we haven't increased our rates as of yet, our fixed rates. So we're still kind of in the same boat we were before the interest rate hike. But if you're looking variable, definitely that's where you're gonna see that difference. And
you go.
I was gonna say, right now, if you're looking at variable, there's different reasons that people will be looking at variable, obviously, because that rate's gonna be a little bit higher in most cases. But the variable rate mortgage just allows you some more flexibility as far as if you're not sure what's going to happen the next few years, and you want to keep that flexibility as far as being able to pay out that mortgage with a lower penalty. That's where people are looking at that rate rather than the fixed at this point.
Yeah. So then, just to go down that rabbit hole, just a quick explanation. What is the penalty to break a variable rate mortgage at Scotiabank versus what potentially a fixed rate one would be? Not dollar amounts, just a quick explanation.
I can't do the dollar amounts in my head. No, just kidding. So it's going to be 3 months interest penalty on the 5-year variable rate. And when you're looking at the fixed rate, lots of different things go into that calculation. So it's basically based on what the interest rates are on the market when you decide to pay out that mortgage, but it's a much more complex calculation. And that interest rate is going to be higher because you are in a fixed term rather than the variable rate term. So your rate doesn't fluctuate.
Just for all you acronym lovers out there, it's known as an IRD, interest rate differential. So if you hear any banker ever talk to you about your IRD penalty, that's what it is. It is talking about the difference in what you owe in interest rate versus, in interest on your existing term versus what they would be able to collect on a new mortgage. So that is what an IRD is, where, like Kayla was saying, a variable rate, they can't determine that. So you get just a 3-month interest charge. So a lot more flexibility with the variable rate. However, if you've gotten in one in the last year, you have been cursing the variable rate versus your fixed one that you may have gotten a year ago at this time. So
and variable rate is kind of, sorry, I was just going to.
Oh, you go. You're the
So
star
variable
of the show, Kayla.
It's kind of an interesting piece there, as far as when we did have interest rates down below. With the variable rate, you're getting almost under 2%, 1.5 mark, when the rates were really good a year and a bit ago. And then, so it's kind of like an investment in variable rate. And that's kind of how I describe it to the clients, is that you're going to be up sometimes and you're going to be low sometimes. But if you ride it out, normally that variable rate will kind of pay off for you. Now, in this kind of rate atmosphere, nobody really knew how high those rates were going to go. So getting into that lower rate, yes, you definitely reap the benefits of that low rate interest rate for quite a few months. And then now that the rate's gone up, we're going to see that other side of things, right?
Yeah. No one expected the rates to go up as hot quickly as they did, because everyone believed the Bank of Canada when they said they wouldn't raise interest rates until 2024.
We believed them.
Yeah. That's your fault, everyone, for trusting the Bank of Canada for its economic outcast. Just joking, you kind of have to. They are the leaders in that field. What was I going to say? Oh, I got all thrown off topic, but not thrown off topic, off train of thought. It was about the variable rate. At ScotiaBank, your variable rates are different than some other financial institutions. Is that correct?
Yes, we are. So what we do is, when that interest rate changes, so does your payment. So not a lot of banks will do that. So if your interest rate, if the prime rate goes up, then your payment's going to go up. And the reason why we do that is that we want to make sure that that same amount is going to principal and interest that you originally signed for, so your amortization doesn't change. Now, other banks will keep your payment the same, and what they'll do is they'll send you out a letter saying that there's not enough money going towards your principal anymore, which means your amortization is going to be extended. Now, the only issue with that is if you come up for renewal and let's say the interest rate's gone up quite a bit over the 5-year term that you locked into, then essentially if that amortization is pushed past the 25 years that's allowable if your mortgage is insured, or 30 if your mortgage is uninsured, which means you at least have 20% equity in the home, then you might have a lump sum payment that you have to put down to bring that amortization back in line. So that's one of the pieces that not a lot of people will know. So they're like, oh, the payments are the same, interest rate went up, it's not really affecting me, but it does, and it can sometimes with that amortization piece. But Scotiabank, what we'll do is we will increase those rates, or we'll lower those, increase those payments or lower those payments. And sometimes it's a little tough as far as if those payments keep going up until, as right now, right, in the current rate atmosphere. But it does make sure that your amortization stays the same. So the amount of time you're paying your mortgage stays the same.
And just for those, again, if you love acronyms, this isn't an acronym, but if you ever heard anyone talk about your trigger rate, that is what they're talking about. They're talking about the rate that was originally picked that's what your payments were based upon, and the interest rate would have to go above that before you would see a drastic change in your payment. Doesn't mean the principal and interest was always calculated correctly, but if you're hearing anyone talk about your trigger rate has been affected, that's what it means, is your now interest rate is above the interest rate that your payment was originally built off of. And Kayla, how much does this most recent interest rate increase from the Bank of Canada affect a variable rate mortgage on a monthly perspective? Is it about $100 a month? I know
It really depends on
it depends on how big the mortgage is. So let's base on every 100,000 borrowed.
So on $100,000 borrowed, again, it depends on your discount, but I would say it'd be around the $80 mark.
Yeah.
Yeah, but it really depends on obviously your mortgage balance, but at your discount on your variable rate as well. So if you have a bigger discount on the prime minus or prime plus on your rate.
Cool. Well, everyone, thank you so much for joining us yet again. We are going to be coming to you live on Monday, June 18th will be our next one. We're going to be talking about Purchase Plus Improvements, which is a completely underutilized product by all financial institutions. So you're going to want to hear about that one, especially with those summer months coming up, and you know you're going to have some projects on the go when you're buying your next house. So definitely tune in. And how you tune in is by either watching us live on Facebook at Maxwell Devonshire Realty or subscribing to our YouTube channel, Maxwell Devonshire Realty, smashing that subscribe button, listening to us on our podcast, Maxwell Devonshire Realty, or watching us later on any of our social media platforms. Kayla, thank you so much again for joining us. It's always a pleasure, and I can't wait to speak with you next week.
Thank you.
See you.